Welcome to BWC News. I am Elizabeth. Recently, OPEC Plus announced that several member countries have announced oil production cuts in order to stabilize international oil prices. Starting from July, the production will be reduced by about 1 million barrels per day. Obviously, this short-term move can support the current persistently low oil prices to stabilize slightly, but, in terms of achieving a global market recovery, it is still treating the symptoms but not the root cause, and the overall effect is very little. In order to further stabilize oil prices, the organization also plans to continue to reduce production capacity to 700,000 to 1 million barrels per day, eventually adjusting daily crude oil production to 40,463,000 barrels per day. Under the current complex and volatile international background, what does this move by OPEC Plus signify? What information is revealed behind the scenes? The catalyst for OPEC Plus, especially Saudi Arabia's big crude oil production cuts, came from the U.S. For one thing, the U.S. just passed a 5-month debt ceiling stalemate in the first week of June and extended the debt ceiling to January 1, 2025, while the Saudi-led OPEC Plus, on the other hand, announced a crude oil production cut extension to the end of 2024 immediately after. Behind this delicate timing is the very initiative of several oil-producing countries around the world to dampen the shock waves for commodities such as oil as they continue to monetize the U.S. national debt and export deficits to the world. Adding to the delicacy is the news in the first week of June that U.S. West Texas-produced Midland-grade WTI crude oil has been included in the live Brent crude oil price system by two of the world's leading energy and commodity price assessors, Argus UK and S&P Global Platts Energy. It is important to know that nearly 80% of the world's physical crude oil trading is anchored by the Brent crude oil price system. This means that U.S.-produced crude oil both dominates its original WTI price system and, at the same time, further dominates and expands its position in the world's premier oil currency system, Brent crude. This is a key signal that U.S. crude is eyeing to take more of the global market and try to grab the established oil market pie from the mouths of multiple oil nations. And for U.S. crude exporters, their future market share may be more competitive if they can enter the market at a lower price than OPEC+. And, the U.S. West has been accusing the Saudi-led OPEC of manipulating oil prices, while OPEC argues that the U.S. has triggered dramatic fluctuations in international oil prices from the previous significant money printing to the Fed's ultra-aggressive interest rate hikes, which has forced oil-producing countries to act to maintain their highly dependent industry profits. Clearly, major oil producers such as Saudi Arabia are increasingly reluctant to see the U.S. get its hands on the global oil economy when both markets and price claims diverge. With the entry of U.S. WTI crude into the Brent price system, it means that the U.S. ambition to export more crude to the world is on full display. The next, once the U.S. crude oil exports on a larger scale, on the one hand, can bring the United States a huge profit at the same time, but also in the direct consolidation of the Petrodollar status, by the way, the use of oil strangle Russia. As we all know, Russia and Saudi Arabia as one of the two most important members of OPEC+. After the outbreak of the Russia-Ukraine conflict, Russian oil and gas exports were blocked by the West on all fronts, and a Russian oil price limit was imposed on Russian oil, causing many European countries to suffer setbacks in crude oil imports and have to change their energy import structure. In order to appease European countries and unite against Russia, the U.S. strongly demanded OPEC Plus to increase oil production to fill the market gap left by Russia. Even Biden personally came to the door, all kinds of bullying, asking Saudi Arabia and other countries to respond honestly to the U.S. policy of increasing production. In fact, Europe, as one of the main exporters of Middle East oil, used to rely mainly on traditional fuel cars to drive oil consumption. Nowadays, the European region is vigorously promoting new energy vehicles and encouraging nuclear energy development, which is undoubtedly an unprecedented challenge for the major oil producers in the Middle East. Once at this time choose to expand production capacity, it is easy to change the relationship between supply and demand, further leading to the decline of international oil prices. This would be like a payback for OPEC Plus members whose oil exports are the lifeblood of their economies. The decline in international energy prices has hit every OPEC Plus member country hard, and in Russia, for example, oil and gas revenues plummeted 46% in January and February this year, dealing Russia a heavy blow that almost didn't slow it down. As the saying goes, the economic base determines the superstructure. From the US perspective, the first task to completely strangle Russia is to destroy its economic lifeline. Saudi Arabia, one of the leaders of the Gulf region, has long suffered from the long-arm jurisdiction of the US and has had to be at the mercy of the US on many issues, but the Saudis are no longer buying it. Despite previous news that the Saudis are questioning the low price of oil sold by Russia, in the face of the US share of the established market share, as well as the US sanctions at every turn, and the ongoing discussion of a bill called NOPEC that seeks to call a halt to the Saudi-led OPEC's international oil control, as well as the future confiscation of oil-producing countries at will, and a series of unfair acts of commodity currency and dollar hegemony. At this time, Saudi Arabia and all 23 OPEC plus oil-producing countries, including Russia, are a community of interest, and the unwarranted US sanctions and dollar hegemony, i.e., the petrodollar, are the targets they need to work together to impact. Meanwhile, over the past few months, the Saudi economy and currency have looked all the way east for good friends. And Saudi Arabia has also continued to change its economic and trade strategy in Middle East oil-producing countries after its rapprochement with Iran and Beijing, continuing to rewrite US control and influence over the Middle East. Multiple analyses show that the US is losing its position and credit weight in the Middle East and among oil-producing countries. This will undoubtedly deal a serious blow to the status of the petrodollar. The oil yuan settlement, which is being accelerated by China and Saudi Arabia, is sniping at the dollar hegemony. At least in the national crude oil market, the era when the US had the final say is gone. Russia, Iran and Venezuela, as major oil producers, have taken steps to divest themselves of the petrodollar, including replacing the dollar with the yuan, and Saudi Arabia, the world's largest oil producer, has made it clear that it is open to selling oil in currencies other than the dollar and no longer accepts US dictates, and has repeatedly declared that it will end the petrodollar agreement it signed with the United States in the 1970s or at some point in the future. The petrodollar agreement with the United States in the 1970s has led to an unprecedented blow to the petrodollar. The analysis suggests that once China, the world's largest importer of crude oil, and the world's largest importer and exporter of commodities, will either sell off more than $760 billion in US treasuries, retaining only $100 billion in US debt levels, or zero out US treasuries, there is a possibility that many oil countries, including Saudi Arabia, and many countries around the world will completely abandon US debt and stop anchoring the dollar for commodity trading. The former governor of the Bank of England, Mark Carney, said that the world will be born. Mark Carney, the former governor of the Bank of England, has said that a new reserve currency will be created globally, and China's petro-yuan offers a new direction for commodity currencies, as it can replace the petrodollar and trade more international oil. China's petro-yuan has done what no one else has done, and from this perspective, the petrodollar agreement that has monopolized the world for more than half a century has in fact come to an end, and the era of no oil without the dollar has come to an end.